In the shadows of global finance, there's a force controlling trillions of dollars shaping the world we live in. Yet most people have never heard its name. This is the story of BlackRock, the quiet giant that holds the keys to your money, your home, and even the future of the planet. Curious to uncover the truth? Hit that subscribe button now and join Zimo Voice as we reveal the hidden power behind the world's most influential company. In the shadows of global finance, there exists a name that has quietly risen to dominate the world economy. A name that, for many years, stayed far from the headlines, far from the constant noise of Wall Street television coverage, and far from the public eye. Yet, behind the curtain, it has extended its influence into governments, corporations, housing markets, energy policy, and even the digital future. That name is BlackRock. For decades, the public conversation about finance revolved around the giants we thought we knew: J.P. Morgan Chase, Goldman Sachs, Citigroup, and Bank of America. These names were symbols of Wall Street, of investment banking, of the ruthless pursuit of money and power. But while attention focused on them, another entity quietly expanded, silently weaving its presence in the fabric of global capitalism. Today, BlackRock is more than just an asset management firm. It is a machine, a $10 trillion giant that holds the keys to the global economy. Through its investments, its technologies, and its vast networks of influence, it has become both omnipresent and invisible. Most people walking down the street have never heard of it, yet their pensions, their mortgages, their paychecks, even the price of food they eat, may in some way be connected to BlackRock's sprawling empire. This is not another mainstream account of Wall Street greed. This is a story of how one company, born in the late 1980s as a small bond management firm, transformed into the largest shadow power on Earth. It is a story of ambition, secrecy, and the unsettling realization that in a world of democracies, the fate of millions may be tied to the decisions of a private corporation. To understand BlackRock, we must begin not with numbers, but with vision, because at its core, BlackRock is not just a financial institution. It is a philosophy, a belief in data, in control, in the ability to manage risk better than anyone else. Its founder, Larry Fink, once a young Wall Street banker who stumbled into disaster early in his career, built the company around a single obsession: never being caught off guard again. That obsession would lead to the creation of Aladdin, a powerful technology platform that now quietly runs the risk management systems of banks, governments, corporations, and investors worldwide. Aladdin, short for Asset Liability, Debt and Derivative Investment Network, is no mere software. It is the nervous system of modern finance, a platform so vast that trillions of dollars in assets depend on it to anticipate risk and calculate opportunity. But Aladdin is only one piece of the puzzle. BlackRock's true power comes from its scale. With over $10 trillion in assets under management, it holds stakes in nearly every major company on Earth. Apple, Microsoft, Amazon, Google, ExxonMobil, Pfizer, Tesla. BlackRock owns slices of them all. And this ownership is not small. In many cases, it is enough to influence corporate decisions, shape boardrooms, and determine the future direction of entire industries. Yet, BlackRock doesn't stop at companies. It owns government bonds, real estate, energy projects, infrastructure. It manages retirement funds for millions of teachers, firefighters, nurses, and ordinary workers. Through this reach, it has become intertwined with the lives of people who may never even know its name. And here lies the paradox. BlackRock insists it does not seek control, that it is merely a steward of capital, investing on behalf of clients. But when you hold the largest voting shares in nearly every major corporation, when you sit in boardrooms and advise governments, when your technology system monitors the financial health of nations, is it really stewardship, or is it something closer to rule? The rise of BlackRock raises profound questions. Questions about democracy, about accountability, about the concentration of power in an age where wealth has become globalized. Who truly runs a world? Elected governments or financial giants hidden in plain sight? To answer these questions, we must travel back to the 1980s, when Larry Fink, a rising star at First Boston Investment Bank, learned the most devastating lesson of his career. In the 1980s, Larry Fink was considered one of the brightest young stars in American finance. At just 30 years old, He was already a managing director at First Boston, one of Wall Street's most prestigious investment banks. Fink was ambitious, sharp, and deeply analytical. He had made a name for himself by pioneering new ways of trading mortgage-backed securities, a product that would later become infamous for its role in the 2008 financial crisis. At that time, though, mortgage-backed securities were considered innovative, even revolutionary. Fink and his team had helped create a market that turned home loans, the mortgages of ordinary Americans, into investment products that could be traded around the world. Investors loved them. For a while, everything seemed like success. Then came 1986. One wrong bet, one unexpected shift in interest rates, and Larry Fink's division at First Boston lost more than $100 million. It was a staggering blow. The same innovation that had propelled his career now nearly destroyed it. In the high-stakes world of Wall Street, such a mistake could end a career. Fink's reputation was tarnished, his future uncertain. But rather than collapse under the weight of failure, Larry Fink made a vow. Never again. Never again would he be blindsided by risk. Never again would he allow numbers to deceive him. Never again would he let a lack of foresight bring ruin. Out of this personal humiliation came a relentless obsession with risk management. And so, in 1988, with 7 partners and a modest $5 million investment, Larry Fink co-founded a small bond management firm. Their goal was simple but ambitious: to build an asset management company that could not only invest money, but control risk with unprecedented precision. That company would become BlackRock. From the beginning, BlackRock distinguished itself from the pack. While other firms focus on aggressive deal-making and chasing the highest possible returns, BlackRock emphasized caution, data, and discipline. Its founders believed that if they could manage risk better than anyone else, clients would trust them with their money. And they were right. One of BlackRock's earliest innovations was building sophisticated computer models to analyze portfolios. At a time when many firms still relied on instinct and phone calls, BlackRock embraced technology. Their systems could simulate thousands of scenarios, predicting how markets might respond to changes in interest rates, inflation, or global events. This focus on technology eventually led to the creation of Aladdin, a platform that started as a risk management tool but grew into the beating heart of global finance. Aladdin wasn't just a calculator. It became a system that could process unimaginable amounts of data, offering insights into the stability of portfolios worth trillions. Banks, governments, corporations, and even rival asset managers began to rely on it. But in those early years, BlackRock was still small, still fighting to prove itself in a crowded industry. The late 1980s and early 1990s were dominated by giants like Merrill Lynch, Goldman Sachs, and Morgan Stanley. To compete, BlackRock leaned heavily on its reputation for discipline and safety. It paid off. Pension funds, insurance companies, and institutional investors, all wary of risk after the market crashes of the 1980s, turned to BlackRock. They wanted not just growth, but security. And that was exactly what Larry Fink promised to deliver. As the 1990s unfolded, BlackRock grew steadily. But behind the steady growth was a vision much larger than anyone yet realized. Fink wasn't building just another asset manager. He was building an empire of trust, one that would quietly insert itself into every corner of the financial system. What began as a small group of outsiders determined to avoid past mistakes was slowly transforming into the most important financial institution the world had never heard of. And as BlackRock grew, so too did its influence, in ways that would reshape not only Wall Street, but the very fabric of the global economy. By the early 1990s, BlackRock had already begun to prove that it was different. In a financial world that rewarded bold risks and fast profits, Larry Fink insisted on discipline. His mantra was clear: managing risk is just as important as making money. That philosophy attracted clients who were tired of volatility, who wanted someone they could trust with billions in retirement funds, insurance assets, and government bonds. One of BlackRock's first big breaks came in 1994, during a turbulent moment in global markets. That year, unexpected interest rate hikes in the United States triggered massive losses for many Wall Street firms. Investors panicked. Portfolios were wiped out. Hedge funds and banks scrambled to explain how they had been caught off guard. But BlackRock stood apart. Its advanced risk models had already factored in the possibility of rate hikes, and its disciplined strategies kept losses under control. While others faltered, BlackRock emerged stronger, its reputation burnished by the crisis. Clients noticed. Money began to flow in. As the decade progressed, BlackRock expanded beyond bonds into stocks, real estate, and alternative investments. Yet it never abandoned its core identity, the company that understood risk better than anyone else. That identity became its brand, a promise to clients that no matter how chaotic the markets became, BlackRock would always be a fortress of stability. Then came a turning point in 1999. BlackRock went public on the New York Stock Exchange, trading under the symbol BLK. The IPO raised its profile and gave it access to capital for expansion. But even more importantly, it signaled that BlackRock was no longer just a boutique manager. It was aiming to compete with the giants. Throughout the early 2000s, BlackRock grew steadily, acquiring smaller firms and expanding its reach. But the moment that truly changed everything came in 2006, when it acquired Merrill Lynch Investment Managers. Overnight, BlackRock doubled in size, becoming one of the largest asset managers in the world. By this point, BlackRock's technology, Aladdin, was becoming its secret weapon. What began as an internal tool for risk management was now being offered outside institutions. Banks, pension funds, insurance companies, even rivals, began to license Aladdin to monitor their own portfolios. It was like renting the brain of BlackRock itself. The more institutions relied on it, the more indispensable BlackRock became. Then, in 2008, the world changed. The global financial crisis exposed the fragility of Wall Street. Lehman Brothers collapsed. Bear Stearns vanished. Citigroup and Bank of America teetered on the edge. Entire economies froze under the weight of toxic mortgage securities. And in the middle of the storm stood BlackRock. Larry Fink, once burned by mortgage securities at First Boston, had sworn to never again underestimate risk. Now, in 2008, that painful lesson gave him an edge. While other firms drowned, BlackRock not only survived, it thrived. Its cautious strategies and powerful technology made it the go-to firm for governments and central banks desperate for solutions. In fact, the U.S. government turned directly to BlackRock to help manage the crisis. Through contracts with the Federal Reserve and the Treasury, BlackRock was entrusted with overseeing billions in toxic assets from failed institutions like Bear Stearns and AIG. It was a stunning moment. A private company, managing public money, effectively helping to steer the rescue of the American financial system. This role cemented BlackRock's reputation as not just another asset manager, but as an essential pillar of global finance. If there was a crisis, governments and corporations alike turned to BlackRock. The company had gone from outsider to insider, from humble beginnings to the very heart of world power. By the end of the 2000s, BlackRock had crossed into a new realm. It wasn't just a money manager. It was becoming something far more, a shadow institution with influence over markets, governments, and the future of capitalism itself. And its power was only beginning to grow. When the dust of the 2008 financial collapse began to settle, Wall Street was littered with ruins. Lehman Brothers was gone. Bear Stearns had been swallowed whole. Citigroup, once a titan, barely survived on life support from the U.S. government. Even Bank of America and Merrill Lynch had been scarred deeply. But amid the wreckage, one name emerged stronger than ever: BlackRock. The crisis that had destroyed others had elevated Larry Fink's firm into the role of rescuer and stabilizer. By managing toxic assets on behalf of the Federal Reserve, BlackRock had earned the trust of policymakers at the highest levels. At the same time, its careful, risk-focused strategy reassured investors who had lost faith in the traditional banking system. Then, in 2009, BlackRock made a move that cemented its position as the undisputed king of global asset management. It acquired Barclays Global Investors (BGI), a deal worth more than $13 billion. With that single transaction, BlackRock's assets under management doubled overnight, soaring past $3 trillion. The deal also brought into BlackRock's portfolio one of the most revolutionary financial products of the era, iShares ETFs. Exchange-traded funds, or ETFs, had been growing quietly in popularity throughout the early 2000s. They allowed investors to buy broad slices of the market, an index, a sector, even commodities, with a single trade. ETFs were cheap, easy to trade, and increasingly favored by both individual investors and institutions. The iShares line, created by Barclays, was a dominant player in this market. By acquiring iShares, BlackRock not only became the largest asset manager in the world, it also positioned itself at the center of the passive investment revolution. This revolution would change finance forever. For decades, Wall Street had been dominated by active managers, stock pickers, analysts, hedge funds, all claiming they could beat the market with skill and insight. But time and again, data showed that most active managers underperformed simple indexes over the long run. Investors began to ask, why pay high fees for mediocre results? ETFs provided the answer. They offered broad market exposure at a fraction of the cost of active funds. And as billions poured into ETFs, BlackRock became the biggest beneficiary. By the 2010s, it controlled the lion's share of the global ETF market. With its dominance came power. BlackRock's holdings now span nearly every major public company on Earth. Through its funds, it owns significant stakes in Apple, Microsoft, Google, Amazon, ExxonMobil, Johnson & Johnson, and countless more. Individually, these stakes might seem small, but collectively, they gave BlackRock immense influence. In many companies, it became one of the top 3 shareholders. This meant that Larry Fink and his team had seats at the table, voting power in boardrooms, influence over corporate strategies, and the ability to push companies on issues ranging from executive pay to climate policy. Critics began to sound alarms. Was it healthy for one private company to hold so much sway over the global economy? How could it be that a firm unknown to most citizens had such vast reach into the companies they worked for, invested in, and bought products from? Yet BlackRock insisted it was simply acting on behalf of clients. It wasn't their money, they argued. It was the pensions of teachers, the savings of firefighters, the retirement funds of nurses. BlackRock was only a steward, channeling capital where investors wanted to go. Still, the sheer scale of its holdings made BlackRock unique. No government, no regulator, no rival could match the reach it now commanded. By the early 2010s, BlackRock was not just the biggest asset manager in the world. It was bigger than entire economies. With trillions under management, it rivaled the GDP of major nations. And Larry Fink, the man who had once nearly lost everything on a bad mortgage trade, now stood as one of the most powerful figures in global finance. But with this power came scrutiny and responsibility. The world was about to enter an era of rising inequality, political instability, and climate crisis. And in each of these battles, BlackRock would find itself at the center. By the early 2010s, BlackRock had reached a scale no one could ignore. With trillions of dollars under management, it was one of the largest shareholders in nearly every major company on Earth. From Silicon Valley tech titans to oil giants in Texas, from European banks to Asian manufacturers, BlackRock's fingerprints were everywhere. And with that ownership came power. Larry Fink understood this better than anyone. Each year, he began writing letters to CEOs, carefully crafted missives sent to the leaders of the world's biggest corporations. In them, he laid out BlackRock's expectations for how companies should act. At first, the letters emphasized additional concerns: sound governance, long-term planning, risk management. But over time, they took on a broader tone. Fink began calling on companies to think beyond short-term profits, to consider their impact on society, the environment, and the global economy. One letter in particular, published in 2018, made headlines around the world. In it, Fink declared that companies must not only deliver financial returns, but also show how they make a positive contribution to society. Without a sense of purpose, he wrote, no company, either public or private, can achieve its full potential. It was a bold statement, especially coming from the head of the largest asset manager on the planet. To some, it was a turning point, proof that corporate capitalism was beginning to take responsibility for its role in climate change, inequality, and social upheaval. To others, it was hypocrisy, a billionaire banker lecturing the world while his firm continued to invest heavily in fossil fuels, defense contractors, and controversial industries. But whether admired or criticized, Fink's letters mattered. When BlackRock spoke, corporations listened. After all, This was a firm that held significant stakes in their companies, the shareholder whose votes could sway board elections, executive pay packages, and corporate policies. Nowhere was this influence felt more sharply than in the debate over climate change. As global awareness of the climate crisis grew, pressure mounted on major financial institutions to divest from fossil fuels and support sustainable energy. Environmental activists turned their attention to BlackRock, pointing out that as the largest asset manager in the world, it was also one of the largest investors in coal, oil, and gas companies. In response, Larry Fink began positioning BlackRock as a leader in sustainable investing. In 2020, he announced that sustainability would be at the heart of BlackRock's investment strategy, declaring climate change a defining factor in the future of finance. The firm pledged to push companies toward cleaner energy and promised to hold boards accountable for failing to prepare for a low-carbon economy. The move was celebrated by some as a breakthrough, a sign that Wall Street was finally taking the climate crisis seriously. But critics accused BlackRock of greenwashing, talking about sustainability, while continuing to pour billions into fossil fuel companies. Activist groups argued that if BlackRock truly wanted to fight climate change, it would divest completely from polluters. Instead, the firm continued to argue for engagement over abandonment, using its influence to pressure companies rather than walking away. Beyond climate, BlackRock also waded into debates about inequality and governance. Larry Fink called for higher wages, better treatment of workers, and long-term thinking from executives. Again, skeptics saw this as rhetoric designed to polish BlackRock's image, while supporters pointed to its voting record in shareholder meetings as evidence of real change. But the larger question was clear. Should a private company, accountable only to its clients and shareholders, wield this much influence over the global economy? BlackRock was not elected. It was not a government, yet its reach extended into policies and boardrooms around the world. This is why some critics began to call BlackRock part of a shadow government of finance, a private empire whose decisions affected the lives of millions, yet operated largely outside of public view. Larry Fink rejected this characterization. He insisted that BlackRock was merely a steward, a caretaker of other people's money. But the reality was harder to ignore. With $10 trillion under management, BlackRock was bigger than almost any government budget on Earth, and its influence was still growing. As the 2010s came to a close, BlackRock had become the defining symbol of financial power in the 21st century, vast, invisible, and everywhere at once. Its supporters saw it as a stabilizing force, a disciplined manager of global capital. Its critics saw it as the ultimate concentration of power, a company too big, too influential, and too unaccountable. But no matter where one stood, one fact was undeniable. BlackRock had become the silent architect of modern capitalism. In 2020, as the world was paralyzed by the outbreak of COVID-19, economies collapsed almost overnight. Stock markets plunged, unemployment soared, and governments scrambled to contain the damage. Trillions of dollars were wiped out in weeks. Fear spread not only through hospitals and streets, but through every corner of the financial system. And once again, when governments looked for answers, they turned to BlackRock. In March 2020, the U.S. Federal Reserve announced an unprecedented rescue plan to stabilize markets. Among its tools was a decision to buy corporate bonds and exchange-traded funds, ETFs, to inject liquidity into the economy. The task of managing these purchases, involving hundreds of billions of dollars, was given to BlackRock. The move was stunning. Here was the most powerful central bank in the world outsourcing one of the most important economic interventions in history to a private company. And not just any private company. The very firm that dominated the ETF market and held stakes in countless corporations whose bonds the Fed was now buying. Critics immediately cried foul. Wasn't this a conflict of interest? How could BlackRock, which stood to benefit from the stabilization of its own funds, be trusted to act purely in the public interest? But the Fed defended the decision, arguing that no one had the expertise, the infrastructure, or the scale to handle such a massive program as quickly and effectively as BlackRock. And it wasn't just in the United States. In Europe, too, the European Central Bank turned to BlackRock for advice on climate strategy and risk management. Around the globe, governments that once saw BlackRock as just another Wall Street firm now relied on it as a trusted partner in crisis. This moment revealed something profound. BlackRock was no longer simply a market participant. It had become a quasi-public institution, a private company performing roles that looked strikingly similar to those of central banks and governments. It was managing public money, stabilizing markets, and shaping the economic response to the most severe global crisis in decades. For supporters, this was proof of BlackRock's importance. Without it, the argument went, the crisis might have spiraled further out of control. For critics, it was proof of something darker, that the line between public power and private influence had all but disappeared. By the end of 2020, BlackRock's influence had grown even larger. As markets recovered, so did its assets under management, surging past $8 trillion. While small businesses shuttered and millions lost jobs, BlackRock's empire only expanded. And Larry Fink, once the man who had nearly been ruined by a single mistake in the 1980s, now found himself in a position few could have imagined. The go-to partner for governments in crisis, the man whose company seemed too important to ignore, too embedded to replace. Yet with this unprecedented power came sharper scrutiny. Activists accused BlackRock of profiting from disaster, pointing to the soaring value of its ETFs as the Fed pumped liquidity into the very funds it managed. Politicians on both the left and right began asking whether it was healthy for a private company to play such a dominant role in public policy. And conspiracy theories flourished online, painting BlackRock as an all-seeing puppet master controlling the fate of the world. Whether exaggerated or not, the perception was clear. BlackRock had crossed a threshold. It was no longer invisible. It was no longer the quiet giant in the background. For the first time, ordinary people began to ask, what is BlackRock? Why does it have so much power? And who, if anyone, keeps it in check? By the time vaccines arrived and economies began to reopen, one fact was undeniable. BlackRock had not only survived the COVID crisis, it had emerged stronger than ever, more entrenched in governments, markets, and societies than at any point in its history. And with that strength came a new question. What comes next? By the time the world began to recover from the pandemic, BlackRock was no longer a shadowy name hidden in the background of finance. It had become a lightning rod, praised by some as a stabilizing force, condemned by others as a threat to democracy, and scrutinized by activists, politicians, and ordinary citizens alike. One of the most explosive controversies was housing. Across the United States, families began noticing something strange. They were being outbid for homes not by other families, but by corporations. In neighborhood after neighborhood, houses were being bought up in bulk by investment firms. And at the center of this trend was BlackRock. Through subsidiaries and funds, BlackRock and other large asset managers had poured billions into residential real estate. The logic was simple. Homes, once considered personal assets, could also be turned into investment products, generating steady rental income. But for ordinary buyers, this meant being priced out of the market. Families trying to buy their first homes suddenly found themselves competing with one of the largest financial institutions in the world. Critics accused BlackRock of fueling the housing crisis, of turning the American dream into a Wall Street asset class. BlackRock pushed back, arguing that its share of the housing market was tiny compared to the overall size, and that it was unfair to single them out. But the optics were damaging. At a time when millennials and working-class families struggled to afford homes, the idea that a $10 trillion firm was snapping up properties struck many as predatory. Housing wasn't the only battleground. BlackRock's stance on climate change and sustainability also drew controversy. Larry Fink had declared climate risk as investment risk and promised that BlackRock would lead in pushing companies toward cleaner energy. The firm joined climate alliances and announced new standards for evaluating corporate sustainability. But critics quickly pointed out the contradictions. Despite its rhetoric, BlackRock remained one of the largest investors in fossil fuel companies worldwide. Environmental groups accused it of greenwashing, talking about climate action while continuing to finance oil pipelines, coal plants, and gas projects. In Europe, activists staged protests outside BlackRock offices, demanding real divestment. At the same time, politicians on the opposite side of the spectrum attacked BlackRock for going too far. In the United States, several conservative states accused BlackRock of promoting a political agenda by pressuring companies on environmental and social issues. Some states even pulled pension funds from BlackRock in protest, framing its focus on ESG, environmental, social, and governance, investing as an ideological overreach. This left BlackRock in a strange position. Attacked from the left for not doing enough. Attacked from the right for doing too much. To some, this was evidence of balance. To others, it was proof that BlackRock's power made it an inevitable target. No matter what stance it took, beyond housing and climate, there was a larger, more unsettling question. Had BlackRock grown too powerful to regulate? With trillions under management, deep ties to governments, and influence over corporate governance worldwide, BlackRock occupied a space no institution had ever held before. It wasn't a bank, so traditional banking regulations didn't apply. It wasn't a government agency, so it wasn't accountable to voters. Yet its decisions affected the lives of millions. Economists began debating whether firms like BlackRock should be treated as systemically important financial institutions, entities so large and central that their collapse could endanger the global economy. If J.P. Morgan, Goldman Sachs, and Citigroup could be regulated as too big to fail, why not BlackRock? Larry Fink bristled at this idea, insisting that BlackRock was different. Unlike banks, he argued, BlackRock didn't lend money or take deposits. It simply managed assets on behalf of clients. But the counterargument was obvious. When you control $10 trillion in assets, more than the GDP of most countries, the lines between management and control blur. By the early 2020s, one thing was clear. BlackRock had become a symbol. To some, it symbolized stability, discipline, and the potential for finance to help solve global problems. To others, it symbolized inequality, concentration of power, and the creeping influence of corporations in every aspect of daily life. And as its power grew, so did the unease. Was BlackRock the cautious steward it claimed to be? Or was it the quiet architect of a world where private corporations wield more power than nations? By 2023, BlackRock had firmly cemented its position as a global financial colossus. Its influence extended far beyond Wall Street trading floors, into policymaking circles, corporate boardrooms, and even the everyday lives of ordinary citizens. For those who understood the scale of its reach, the reality was both awe-inspiring and unsettling. A single private company had become a keystone of the modern economic system. BlackRock's reach into government continued to grow, often under the radar. Central banks and ministries consulted its executives for insights on everything from bond purchases to climate risk management. In Europe, Asia, and North America alike, BlackRock's analytics, forecasts, and risk assessments shaped decisions that affected millions. It was in many ways an unelected advisor to the world's most powerful institutions, a shadow consultant with unprecedented access. Yet this dominance did not come without scrutiny. Journalists, academics, and activists began asking increasingly difficult questions. Could a private entity so deeply intertwined with governments operate without oversight? Was BlackRock acting as a neutral steward of its clients' money, or as a hidden policymaker guiding entire economies? The paradox was striking. The very technology and strategies that had made it indispensable also created vulnerabilities for democracy itself. Meanwhile, the firm's influence in financial markets became more apparent. BlackRock's ETFs and mutual funds held stakes across nearly every sector. Its voting power in boardrooms often shaped corporate decisions, from executive pay to mergers and acquisitions. Even subtle shifts in BlackRock's portfolio could ripple across markets, influencing asset prices, investor behavior, and corporate strategy. For smaller investors and pension holders, this power was invisible, but for those paying close attention, it was profound. Housing remained a flashpoint. BlackRock's acquisitions of residential properties, through subsidiaries and investment funds, continued to generate controversy. Families seeking first homes often found themselves outbid by institutions with near unlimited capital. Critics argued this exacerbated inequality and inflated housing costs, while supporters claimed that institutional investment brought efficiency and professional management to the rental market. Regardless of the interpretation, the narrative reinforced the growing perception that BlackRock was shaping society in ways most people could barely see. Climate and sustainability, too, remained complex. Larry Fink's annual letters continue to urge companies to adopt ESG principles, emphasizing the long-term risks of climate change and poor governance. BlackRock invested heavily in renewable energy funds and green infrastructure, signaling its intention to be seen as a responsible force in global finance. Yet, despite these pledges, its ongoing investments in fossil fuels and defense sectors sparked ongoing debates about credibility and greenwashing. Activists argued that the firm had the leverage to force more radical change, but preferred incremental influence. BlackRock's growing profile also created geopolitical implications. Nations watched closely as BlackRock entered emerging markets, offering financial products and advisory services that sometimes intersected with national development plans. Its role as a major shareholder in multinational corporations gave it leverage across borders, subtly influencing global supply chains, technology development, and resource management. Some analysts warned that a single entity with such a global footprint blurred the line between corporate power and state influence. And then came the question of regulation, or the lack thereof. While traditional banks were heavily monitored, BlackRock operated in a gray area. It did not accept deposits. It did not lend directly to consumers. And yet its financial footprint was immense. Policymakers and economists debated whether new frameworks were needed to ensure accountability, to prevent conflicts of interest, and to manage systemic risk. Some suggested treating asset managers of its scale as too influential to ignore, echoing debates that had once applied only to banks deemed too big to fail. For ordinary citizens, BlackRock's reach was often invisible, yet undeniable. Retirement accounts, pension funds, and mutual investments frequently channel money into funds managed by the firm. Their influence touched the cost of housing, the stability of employment-linked pensions, and even performance of everyday consumer goods companies. Most people would never meet a BlackRock employee, never see its offices, and never read its reports, but their financial lives were quietly intertwined with the firm's decisions. This quiet omnipresence created a new kind of power, one that operated behind the scenes, largely insulated from public scrutiny. BlackRock had become a force capable of influencing not just markets, but society itself. It was a new model of corporate power, networked, technologically sophisticated, and deeply integrated into machinery of both private and public finance. Yet, as with any concentration of power, questions persisted. Could such a firm remain accountable to the people whose money it managed, the governments it advised, and the global economy it subtly guided? Could transparency, oversight, and public trust survive when one entity held sway over trillions of dollars and the fate of millions? As BlackRock looked toward the future, it faced unprecedented challenges and opportunities. Economic turbulence, technological disruption, climate crises, and social unrest all lay ahead. The decisions made in its offices by executives wielding influence unseen by the public could shape the trajectory of nations. Its power, at once invisible and colossal, was a defining feature of the 21st century global economy, a reminder that in a world increasingly defined by networks of capital, influence often flows quietly but absolutely. In the shadows of the financial world, one question lingered. Could any individual, any company, truly hold such sway without consequence? Or had BlackRock become the silent architect of the rules by which the modern world must play? The answer was unfolding quietly in boardrooms, on trading floors, and in the algorithms of the most powerful financial systems on Earth. And for the rest of the world, the story was far from over. As the 2020s progressed, a new wave of financial innovation began to intersect with BlackRock's empire: artificial intelligence, big data, and digital currencies. The firm, long a pioneer in financial technology through Aladdin, was uniquely positioned to capitalize on these trends. Its systems could analyze trillions of data points daily, predict market movements, and model scenarios far beyond human capacity. AI-driven portfolio management promised unprecedented precision. BlackRock's algorithms could anticipate risk, rebalance investments, and optimize returns with a speed and accuracy no human team could match. For investors, this meant better performance, lower volatility, and access to insights previously reserved for elite traders. But for critics, it raised troubling questions. If algorithms controlled trillions in assets and guided corporate decision-making, who or what was really in charge? The rise of digital currencies and central bank digital currencies, CBDCs, added another layer of influence. BlackRock was quietly advising governments on how to structure these new financial instruments, while also investing in related technologies. The firm's expertise in risk management and global markets made it a natural partner in these efforts, giving it a voice in shaping the very architecture of tomorrow's monetary systems. Meanwhile, the firm's activism on corporate governance and ESG issues intensified. Larry Fink's letters have become an annual global event, widely analyzed by media and financial institutions alike. Each year, his messages nudge companies toward longer-term thinking, climate accountability, and social responsibility. Yet as BlackRock's stakes in corporations expanded, the line between advice and influence blurred further. Corporations often felt compelled to align with BlackRock's expectations, not merely as investors, but as stakeholders with enough voting power to affect boardroom decisions. Global events also tested BlackRock's role as a stabilizer. Geopolitical conflicts, trade tensions, and climate disasters created waves of uncertainty across markets. When governments sought guidance, BlackRock's analysts were ready, providing risk assessments, crisis simulations, and portfolio strategies. The firm's presence in these situations was quietly omnipresent. Its fingerprints were on the financial levers that helped governments and corporations navigate chaos. Yet with power came controversy. Critics continue to argue that BlackRock's dominance posed systemic risks. Could one company, operating with minimal public accountability, destabilize the global economy if it miscalculated? Were ordinary citizens, whose pensions and investments flowed through its funds, unknowingly tied to decisions made in private boardrooms? The perception of a shadow government persisted, amplified by investigative journalists and scholars examining the concentration of wealth and influence. Social media, too, became a platform where narratives about BlackRock flourished. Online communities debated its role in housing, climate, and financial crises. Some painted the firm as a guardian of global stability, while others portrayed it as a monopolistic power threatening democracy itself. The duality of perception, admiration, and suspicion underscored the complexity of BlackRock's position in the modern world. Amid this scrutiny, BlackRock continued to innovate. Its technology systems expanded beyond Aladdin, incorporating AI-driven risk assessment for environmental disasters, supply chain disruptions, and global trade patterns. The firm invested in predictive analytics that could model the economic impact of pandemics, geopolitical conflicts, and even technological shifts such as autonomous vehicles and renewable energy adoption. These tools positioned BlackRock as both an investor and a strategic advisor with unparalleled foresight. The broader implication was clear. BlackRock had become not just a financial powerhouse, but a key architect of systemic economic intelligence. Its influence extended to shaping how governments, corporations, and investors perceived and responded to risk. Decisions once made in isolation now bore the imprint of a single, quietly omnipresent institution. Yet, even as BlackRock's reach expanded, uncertainty loomed. Questions about regulation, transparency, and accountability persisted. How would governments ensure that such a powerful entity operated fairly? Could global markets withstand the influence of a firm that effectively had a hand in nearly every major company, sector, and nation? And most fundamentally, in a world increasingly governed by algorithms and data, where human oversight was limited, who truly held the reins of power? The story of BlackRock was no longer just a tale of financial success. It was a story about the evolution of power itself, a reflection of how private institutions could quietly shape the economic, social, and even political realities of our time. And as new technologies, crises, and opportunities emerge, the world will be forced to reckon with a simple truth. In the 21st century, the architects of finance might wield more influence than the architects of nations. The next chapter was unfolding, and its consequences would touch every corner of society, from the wealthiest boardrooms in Manhattan to the smallest households struggling to make ends meet. BlackRock, once a small bond management firm, had become a silent force capable of shaping the global economy itself. And for the billions of people whose lives were intertwined with its decisions, understanding this quiet giant was no longer optional. It was essential. As the 2020s progressed toward 2030, BlackRock's role in global finance was entering uncharted territory. The firm's influence was no longer confined to traditional markets or corporate boardrooms. It was expanding into areas previously considered the domain of governments and international institutions. From climate strategy to digital infrastructure, BlackRock had quietly positioned itself as a key architect of the future economy. One arena where this influence became especially evident was in climate finance. Governments and corporations faced mounting pressure to transition toward a low-carbon economy, yet the scale of required investment was staggering. BlackRock's funds, ESG mandates, and advisory services became instrumental in directing trillions of dollars toward renewable energy, sustainable infrastructure, and carbon reduction initiatives. Its voice in corporate decision-making, combined with its massive portfolio, gave it leverage unmatched by any single nation. Yet the firm's climate activism was not without controversy. Environmental groups praised BlackRock's efforts to push companies toward cleaner practices, but critics argued that it was still deeply invested in fossil fuels, often benefiting from the very industries it claimed to regulate. This duality, the balance between influence and investment, highlighted a recurring theme in BlackRock's story. Power, even when exercised responsibly, could rarely be disentangled from self-interest. Technology also offered new avenues of influence. BlackRock's Aladdin platform, already a cornerstone of global financial management, was evolving. AI-driven predictive models allowed the firm to simulate economic shocks, market volatility, and geopolitical crises with astonishing accuracy. Governments and multinational corporations increasingly relied on these simulations to plan responses to pandemics, trade disruptions, and climate disasters. In effect, BlackRock had become a central hub of global economic intelligence. Digital currencies were another frontier, with central banks exploring CBDCs and private cryptocurrencies gaining traction. BlackRock was quietly advising policymakers and investing in blockchain infrastructure. Its expertise in risk assessment and asset management made it a sought-after partner in designing digital financial systems. This gave the firm the ability to influence the underlying architecture of future monetary systems. Another layer of power few outsiders fully understood. The firm's reach extended beyond finance into societal structures. BlackRock's ownership stakes in housing, infrastructure, and energy projects meant that its decisions affected everyday life, from rental costs to access to renewable energy. Even if individuals never interacted with the firm directly, its influence touched millions of homes, workplaces, and public services worldwide. Political influence, while subtle, was equally significant. BlackRock executives participated in high-level advisory councils, contributed research to think tanks, and provided data-driven insights that shaped policy decisions. In elections, budget planning, and regulatory frameworks, the firm's fingerprints were increasingly evident. Yet, unlike governments or elected officials, BlackRock remained insulated from direct accountability, operating in a sphere where influence could be exercised quietly, efficiently, and often without public scrutiny. Critics of this concentration of power raised urgent questions. Could a private firm, accountable primarily to its shareholders, wield influence over global markets, governments, and critical infrastructure without posing systemic risks? Could democratic institutions maintain oversight when the decisions of a single firm could shift economies, affect employment, and influence climate policy? These debates intensified as BlackRock's assets under management continued to grow, surpassing $10 trillion and expanding its reach even further. Even as scrutiny increased, the firm's philosophy remained unchanged. BlackRock framed its actions as stewardship, emphasizing long-term thinking, risk management, and societal responsibility. Yet the scale of its operations meant that every choice, every investment, every vote in a corporate boardroom, every advisory note to a government carried global consequences. Its philosophy was no longer just a business strategy. It was a blueprint for exercising power in the modern world. As the decade advanced, the interplay of technology, finance, and influence created unprecedented complexity. BlackRock's AI-driven models began to predict social trends, market reactions to policy changes, and even the economic effects of climate events. Its ability to anticipate risk, once a tool for investors, now became a strategic lever with far-reaching implications. In many ways, the firm had become a silent regulator of global economic stability, with its own proprietary algorithms guiding decisions that could affect nations. The paradox of BlackRock's power remained. It was neither a government nor a traditional bank, yet operated in spheres that historically belonged to both. Its decisions affected jobs, energy supply, corporate strategies, and financial security. Yet transparency and accountability often lagged behind influence. Ordinary citizens rarely knew the depth of BlackRock's reach, while policymakers struggled to balance reliance on its expertise with oversight. And so the story of BlackRock entered a new phase, one defined by unprecedented opportunity, unparalleled power, and mounting responsibility. The firm had evolved from a small bond management company into a global force capable of shaping the trajectory of economies, societies, and even environmental outcomes. For the world, the question was no longer whether BlackRock was powerful. It was how the world would respond to a company whose influence spanned finance, policy, technology, and society, a firm that operated quietly yet decisively in a space where corporate ambition, public interest, and global stability intersected. In the decades to come, BlackRock's legacy would not be measured solely in dollars managed or profits earned. It would be measured in the breadth of its influence, the depth of its decisions, and the extent to which a single firm could quietly steer the currents of the 21st century world. The story was far from over, and as the firm looked toward an uncertain future, one truth remained clear. BlackRock was no longer just a player in the global economy. It had become one of its architects, a silent power shaping the world in ways most could barely perceive, but none could ignore. By the mid-2030s, BlackRock's influence had reached a level few could have imagined. Its systems, built on decades of data accumulation and AI innovation, had evolved into what many analysts described as a nervous system of global finance. The firm no longer merely reacted to economic events. It anticipated them, sometimes months or years in advance. Artificial intelligence had become central to this transformation. Aladdin and its successors could model the behavior of entire markets, simulate the effects of geopolitical shifts, and even predict social unrest tied to economic conditions. These tools allowed BlackRock to make investment decisions with unprecedented foresight. Governments and corporations increasingly relied on its analyses to navigate crises, while ordinary citizens remained largely unaware of how deeply the firm's influence touched their daily lives. Digital currencies and blockchain technologies were now embedded into the global financial system. Central banks had adopted versions of digital money that BlackRock had helped design or advise on, giving the firm indirect sway over monetary policy. With these tools, it could track capital flows, assess systemic risk, and guide economic interventions with a precision that blurred the lines between public policy and private influence. The firm's reach into housing and infrastructure had intensified. In many urban centers, BlackRock-owned subsidiaries controlled significant portions of residential real estate, commercial properties, and key infrastructure projects. Critics argue that this level of ownership concentrated power in ways that could exacerbate inequality, influence urban planning, and even affect democratic processes. Supporters countered that professional management of these assets could stabilize markets and increase efficiency. But the debate highlighted a growing tension between private control and public consequence. Global crises, whether climate disasters, pandemics, or geopolitical conflicts, provided opportunities to demonstrate BlackRock's utility and influence. During climate-related catastrophes, the firm's predictive models guided investment in resilient infrastructure, renewable energy, and emergency relief financing. While these interventions often mitigated immediate damage, they also reinforced perception that BlackRock had become an invisible hand shaping the responses of entire nations. Policy influence had also deepened. BlackRock executives were now regular participants in international economic councils and advisory boards. Their insights informed regulatory frameworks, climate strategies, and corporate governance guidelines. The firm's recommendations carried weight not only because of its financial clout, but because its data-driven simulations provided a level of predictive insight governments could rarely replicate. Yet with immense power came immense scrutiny. Academics, journalists, and civil society organizations increasingly warned about systemic risk and accountability. Could a private company wielding such influence operate without creating conflicts of interest or without inadvertently steering economies in ways that favor its own investments? The firm's assurances of acting in the interest of clients were often questioned in a world where clients included sovereign funds, pension systems, and public institutions. Social impact was also profound. Ordinary citizens were often unaware of the ways BlackRock's decisions shaped their lives. Retirement funds, mortgage rates, rental markets, and access to critical services were all indirectly tied to the firm's strategies. This invisibility became a defining characteristic of its power. Influence without visibility, control without direct interaction, and consequences felt globally but understood locally. By 2040, BlackRock's AI systems had evolved to such sophistication that they were not only managing risk, but simulating potential global economic scenarios decades into the future. Governments, corporations, and investors increasingly treated its projections as authoritative guidance, elevating a single private firm into a quasi-strategic position that rivaled, and sometimes surpassed, traditional national institutions. This concentration of influence raised ethical and philosophical questions. Could one firm, accountable primarily to shareholders, legitimately guide decisions affecting billions of people? Was it possible to balance private profit, public responsibility, and global stability when a single entity had such far-reaching reach? And as algorithms increasingly replace human judgment, who or what would ultimately bear responsibility for the outcomes? In this speculative future, BlackRock had become more than a financial institution. It was a silent architect of global systems, a hidden force shaping markets, policy, society, and the environment. Its power was subtle, often invisible, but absolute in scale. The firm had evolved from a small bond management company into a central node in the architecture of 21st century civilization. For the world, the question was no longer if BlackRock mattered. It was how societies, governments, and individuals would adapt to a reality where a single private company could influence economies, infrastructures, and policies on a global scale. The implications were enormous, and the consequences, whether stabilizing or destabilizing, were still unfolding. The story of BlackRock, born from a vow to never be blindsided by risk, had become a story of power, foresight, and influence unprecedented in human history. And as 2040 approached, one truth remained clear. In the modern world, the quiet giants of finance could shape destinies as profoundly as any government, yet their influence often remained unseen, unchallenged, and inescapable. By the mid-2040s, BlackRock's reach had grown into realms that were once considered purely governmental. Macroeconomic stabilization, climate strategy, and even societal forecasting. Its AI-driven platforms had evolved far beyond financial modeling. Now capable of simulating human behavior, demographic shifts, and geopolitical tensions, BlackRock could anticipate crises before they emerge and propose, or enforce strategies to mitigate them. Governments increasingly treated BlackRock as an indispensable partner. Its expertise was sought not only for financial stabilization, but for policy design, urban planning, and climate mitigation. In cities across the world, infrastructure investments were guided by BlackRock's predictive analytics, optimizing energy grids, transportation systems, and housing developments to maximize efficiency and minimize risk. At the same time, BlackRock's dominance in corporate governance had deepened. With substantial stakes in nearly every major global company, the firm's recommendations carried extraordinary weight. Boardrooms began to function almost as extensions of an advisory framework, with corporate decisions increasingly aligned to BlackRock's projections for long-term profitability and stability. Even decisions about wages, environmental impact, and technological innovation were influenced by algorithms designed to optimize outcomes for both investors and systemic stability. The integration of AI into BlackRock's operations raised profound ethical questions. If artificial intelligence could predict market behavior, social unrest, and environmental outcomes with high accuracy, then who truly controlled the levers of society? The humans in power or the systems they relied on? Critics warn of an unprecedented concentration of authority. A private company operating algorithms capable of shaping not only economies, but the social fabric itself. Financial crises, once chaotic and unpredictable, became increasingly rare, but not because the world had solved its economic vulnerabilities. Rather, BlackRock's foresight allowed preemptive measures, stabilizing markets before shocks could cascade. While this created unprecedented prosperity in some regions, it also meant that the firm had a hand in guiding the outcomes of billions of lives, subtly deciding winners and losers in ways invisible to the public. Digital currencies had now become mainstream, with many nations issuing BlackRock-advised versions of CBDCs. These currencies allowed unprecedented tracking of economic activity and enabled the firm to model and influence global financial flows with unmatched precision. It was no longer just a financial advisor. It was shaping the very architecture of money itself. Housing and infrastructure remained another domain of influence. BlackRock-owned subsidiaries control vast urban developments, renewable energy grids, and critical resource networks. Ordinary citizens, often unaware of the firm's ownership, experience its influence in the cost of living, access to energy, and availability of housing. The line between private investment and public consequence had become increasingly blurred. By the late 2040s, the firm's societal influence extended into education, health systems, and workforce management. AI-driven projections guided the allocation of resources for training, labor markets, and healthcare infrastructure. While these systems optimize efficiency and stability, they also centralize power in a way unprecedented in history. A single private entity, operating across finance, governance, infrastructure, and society, wielded influence rivaling that of sovereign states. Yet even as BlackRock's dominance grew, scrutiny intensified. Governments debated regulation. Civil society questioned accountability, and public awareness slowly increased. Social movements arose calling for transparency, ethical oversight, and redistribution of influence. Scholars warned that the world risked creating a form of algorithmic governance in which a private company, albeit one acting under guise of stewardship, effectively directed the course of nations. By 2050, BlackRock had become more than a financial institution. It was a global infrastructure for decision-making, a silent architect shaping economies, societies, and environments simultaneously. Its systems dictate financial flows, advise policymakers, influence corporate boards, and even forecasted societal trends. Its influence was pervasive, subtle, and virtually inescapable. The story of BlackRock, which began with Larry Fink's vow to never be blindsided by risk, had transformed into a narrative about power itself. The evolution of influence from the visible to the invisible, from wealth to systemic authority, from investment to control. The ultimate question remained. In a world where a single private firm could steer global systems, who, or what, held the final responsibility? And how would humanity navigate a future in which the line between private ambition and public consequence had blurred beyond recognition? As the world looked ahead, one fact was undeniable. BlackRock was no longer just a company. It was a force, silent, omnipresent, and shaping the course of human civilization itself. As the mid-21st century approached, the story of BlackRock became a reflection of humanity's relationship with power, technology, and finance. From a small bond management firm in the 1980s to a global force shaping economies, infrastructure, and societies, BlackRock had quietly evolved into a silent architect of modern civilization. Its influence was both awe-inspiring and unsettling, a reminder that in a world driven by data, capital, and algorithms, power could be concentrated in unexpected, invisible hands. BlackRock's journey was not merely a story about money or markets. It was about vision, foresight, and the ability to adapt to a rapidly changing world. It was about how a single company, guided by discipline, technology, and ambition, could come to influence everything from the homes we live in to the energy we use, to the very decisions that shape global policy. Yet, with all this power came responsibility. BlackRock's influence was a test for the world, a challenge to balance private innovation with public accountability, foresight with ethics, and ambition with transparency. Its story was a reminder that the decisions made in boardrooms, servers, and AI algorithms could ripple across continents, shaping the lives of millions, often without their awareness. And so, the story ends not with certainty, but with reflection. BlackRock's legacy is still being written. Its systems continue to evolve. Its reach continues to expand. And the questions it raises about power, control, and responsibility remain as urgent as ever. What will the world do with such influence? How will societies, governments, and individuals respond? That, ultimately, is a story still unfolding, one in which every choice, every policy, and every investment matters. Thank you for joining us on this journey into the hidden world of BlackRock, the quiet giant that has shaped the 21st century in ways most people will never see. If this story gave you new insights into the hidden forces of global finance, make sure to share your thoughts in the comments. We'd love to hear what you think about the influence of companies like BlackRock and how you see the future unfolding. And don't forget to subscribe to our channel for more in-depth documentaries that uncover the stories behind the world's most powerful institutions, corporations, and events. Your curiosity fuels the exploration of the hidden world around us.